Hey guys, this is Kenny over at Learn How to Prosper, and I'm going to share with you my daily routine as I do every day. And here I am in the Prosper Trading platform. And by the way, just so you're aware, this is an app I created, and it connects to my brokerage, which is Tasty Trade. And sometimes I'll come and operate and do some of my daily trading in Tasty Trade, and other times I'm going to do it with my app. I use my app because I can manage multiple positions all at the same time, which is really ideal. So usually I'm just going to, today is let's see, 21st of July. So I'm just over halfway through the month. I'm at about $163 and $652,000 for the year on premiums. So a lot of people, it's funny when I talk to them about trading, they always think that it's like day trading. Day traders, and I say this kindly, are idiots. Do not do day trading. No, and I don't, and options trading is you're selling. I should even say option selling. I sell insurance contracts on people's stock portfolios. And you can do it too. This is the way big insurance companies make their money. It's the way that when you turn your money over to a BlackRock or a Citadel or these large pension funds, they're all of them, hedge funds, they're all using options in the background. That's how they make their money. So it's a joke when people say, oh, that's so risky. No, what's risky is turning that over and outsourcing it to other people. I'm not saying that there's not risk involved, because every investment on the planet has risk, but you can massively mitigate your risk by using what all insurance companies have are actuaries. So in the trading world, you have something called delta, and it gives you an indication of the probability that you will keep the premium of an options contract that you sell. So I'm going to show that today, but before I do, let's go through just my daily actions. So typically what I do is I will come in to my scanner here, and the first thing I want to take a look at is which of my positions can I buy back? Think of this as I sold an insurance contract on AMD, and now let's say I sold it for $400, and today I'm going to buy it back for a fraction of that. So I have 23 positions. Everything that's 70 or above, I'm just going to buy them back. So Nimbus, AMD, FCX, most of these are cash secured puts, but I'm just going to buy them back. Every one of them, I'm going to turn around. Now, if you could buy a car for $500 today and turn around, if you could sell a car for $500 today and buy it back for $50 tomorrow, would you do that? And then would you turn around and sell it for $500 again and then buy it back a few days later for $50 and do it over and over and over again? That's what I'm doing with stock. In essence, a cash secured put means that I'm putting cash collateral, making that available. And I write up a contract that says, if your stock drops to a certain level, I'll buy it. And they pay me for that. They pay me a premium. It's actually insurance. They're paying me a premium to protect their portfolio. Now, let's say that if stock drops below that level, then I get to buy their stock at a discount. Now I own that stock. Now that I own the stock, I can now sell an insurance contract on the other side, and that's called a covered call. And so in practice, that's the wheel. It's called the wheel because round and round it goes. So let's go ahead and do this. Do I have all of them? Yeah. I'm going to pick up this one and just turn to 70. Okay. So now I'm going to review these. What happened? Let me review these. Okay. So I always there's a buyer and a seller, and both wants to get the best deal. So what I always do is I just put it right in the middle, halfway to what I want and half as a seller, and halfway what they want as a buyer. And by the way, this is all automated, so don't be thinking you're actually interacting with individual human beings. It's not the case. So I just put that in the middle. It's going to cost me $887 to buy back these positions. So I'm going to go ahead and do that. Okay. So I'm just giving that a minute here. It's going to go and validate each one of these. There it is. It's validating. See it right here. And off it goes. Yep, and I can see I'm being notified on my phone that all of these are, yep, they're going through. They're filling is the way that you would say it. Each one of these is filling. And confetti, because the success was had. So now what I like to do is then I'll come up under working orders, because you can submit an order. It doesn't mean it fills. So what I'll do is I'll come out, oftentimes I'll look at these and I'll say, well, I want it to fill. So I'm going to select them. I'm going to look at these and maybe move it just to where it's just a little bit more appealing, in this case, to the seller, because I'm buying it back. And then I'll confirm those and let that run. It looks like 2 of those replaced, 1 of them didn't. Okay, now after I've done that, I come back, and now that I've purchased certain positions back, I'm going to go and see if I have any eligible covered calls. Looks like I don't have any eligible covered calls right now. So now what I'm going to do is I'm going to go over and I'm going to find some new contracts. This is cash secured put. I'm going to find some new contracts that I can sell some insurance contracts against. So I've got 101 different tickers. These are, you might recognize them: American Airlines, Apple, Adobe, AMD, Amazon, digital. Anyway, it's got a whole bunch of these. Well, normally in a typical brokerage, I would have to go and individually evaluate each one of those. Well, I'm not going to have to do that. So today, let's see what's looking good. So I'm gonna send this off to do a scan. I'm gonna pause it. All right, that took about 34 seconds to scan 101 tickers across thousands and thousands and thousands of contracts. And it brought back only those contracts that would actually be appealing. And then I run a score on them using all different types of technical analysis. Many of these you could see when you look at a chart for a particular stock. So for example, this is Nimbus, and you can see that it kind of went down, but now it's making its way back up. Here, this is the RSI, the relative strength index. And whenever this little, when you see this little line goes above the 70 mark, that means that this stock has been a little bit overbought. And when it drops down below 30, that means it's been oversold. I usually like to look at stock and picking it up when it's on a day where it's kind of in the middle here, right in the middle of the RSI index. You can also see this is its growth over time. Each of these green lines are called Bollinger Bands. It's the average of the movement of that stock. Each one of these little vertical bars are called candlesticks. Kind of looks like a candle. It's got the candle and the wick. On reds, that means that it was being sold off. On greens, it means it's being bought for a higher price. So I kind of like this one. So I'm going to select it. It's got an overall score of 77. It's this contract. All contracts expire. This one expires in 9 days. I'm going to collect a premium of $6.18 per share. Every contract is 100 shares, so that's $618. Now, the one thing I do need to do here, make sure I've got some buying power. I've got about 99,000 of buying power here. So I'm going to select Nimbus. What's another one that I want to look at? I like Amazon. Let's take a look at what Amazon is doing. So if I click on the chart, I can, kind of the same thing. I mean, you can see that back in May, it pumped up. In June, and then it's been kind of on a down through June into July, and now it's kind of making its way back up. And you can see that we're kind of in the middle of the. Do this. We're in the middle of the relative strength index. It's a good place to be. It's making its way back up. It's got pretty good volume. It's got good interest. Yeah. I'm going to select these two. And maybe iron. Nah. Okay. Now, today, I've just called out, an overall score, and that score is made up of these things. The liquidity, meaning how many other people are interested, how many other folks are interested in selling their contracts. It's fairly good liquidity. The probability of this expiring worthless, meaning of me collecting the premium without the stock being assigned, is pretty high. The premium is high, meaning I'm getting a good payment out of it. The implied volatility, the IV, it's pretty good because the more volatile, the better for premiums. Strike safety looks like it's pretty safe. It's most likely not going to go below my strike price, because when you look here at NBIS, you can see that Nimbus. There you go, Nimbus. So you can see that the price is currently at 207. It would have to drop to 155 for this to be assigned. Well, if it drops to 155, that's a good place to get in. So I'm happy about that. So I'm happy either way. I'm happy if the stock never drops below that, because I just collect this $618 premium, or it's assigned to me and I'm happy because I got it at a discount. Same with Amazon. So I'm going to test these orders. So this is going to open up my dialog, my order ticket. I can see I'm right in the middle. So this is around $818. I'm going to go ahead and execute a dry run. And then I'm going to submit that. And off it goes. Great. Okay. Well, that's just a quick peek. I'm going to go and do some more, but I don't want this video to get any longer. It's already at 13 minutes, so I'm going to knock off here. But if you would like to learn more about this, then you can click in the link. I actually have a course, and I walk through all of this, how to use tastytrade, what options are, all the technicals. So just click on that link if you'd like to learn more. And with that, I'm going to sign off for today. And I hope you have a fantastic, blessed, and wonderful day.